about in the next half hour or so is not what's down on the programme, and I found I was rather short of time, and so I wanted to be much more modest. There was a conference here in 2013, which I then edited a book about, about money in the Great Recession, and the main argument of my contribution to that was that it was very paradoxical, which was that the raising of banks' capital asset ratios after the, mostly from October 2008, had the effect of causing banks to shrink their risk assets, to destroy money, with the effect that the rate of growth, the quantity of money, collapsed. Indeed, money growth might actually, money itself might have fallen, and that the bank recapitalisation exercise was therefore the main cause, certainly the intensification of the Great Recession in late 2008 and early 2009. Now, obviously, a conclusion of that sort is so startling that you might wonder, quite whether. What I want to do today is to look at the longer-term consequences of the bank recapitalisation exercise, really focusing on the UK data, and particularly on banks' assets. There's plenty of data, by the way, and you can, from the Bank of England's database, you can get figures for the consolidated profits and so on of the UK banking system in the last.
But they don't match up with what I'm finding at the granular level.
Well, let's say not, but the figures are there, and anyway, so I will actually be using one chart from, one table from chapter 5 by Adam Ridley of the book. In fact, I put the table together, in fact, helping out Adam. So. Now, what I want to do, a bit like Geoffrey and Forrest, is to go back some way. So, if I could, I was going to look at this thing. I'm going to go back to the immediate post-war situation in the UK. This is the composition of clearing banks' assets in 1945. The main point I want to make is that the advances to customers bit, the light blue, 15.5%, was less than a sixth of total bank assets. And UK banks' assets at that time were dominated by claims on the state. Obviously, it's not surprising after a war. Similar situation was true in the United States. Anyway, roughly 80% of UK banks' assets were claimed on the government. Now, this changed, and the comments Geoffrey made about the capital banks had, in fact, they had very low capital relative to total assets in the immediate post-war decades. But there was a lot of business to do. And so we then had this rather long period of about 25 years when there was occasional liberalisation of banks, tremendous growth of bank credit. And then finally, 1971, competition and credit control, tremendous growth of bank credit, a couple-year period, huge boom and the rest of it, and then some of us started interested in money. And now, when we get to the late 1980s, the balance sheet of UK banks had been transformed totally, and they essentially had no claims on the state at all. Practically all assets were claims on the private sector, and sometimes there were claims on international claims on foreign private sector, and including foreign banks. So this is the picture of the sterling assets. Of course, there are UK banks as a whole foreign currency assets, but sterling assets, and I've excluded the foreign claims. You can see that from 1991 through to 2008, essentially British banks had no claims on the public sector, on the state, on the government at all. Total change, and the quantity of rapid growth of lending to the private sector, and so on. This reaching a peak in 2009 on the bottom. Now, just warn you that the numbers that I'm about to show you are from the Bank of England, that's their official numbers. The data are very difficult to work with. There's a lot of series breaks, a lot of reclassifications, All I will say is I'm giving this to you in good faith. All right, I'm not making this up. Let me get this debate, end this discussion with James, what really going on in bank losses. And I'm pleased to have some bankers here, because we really do need some help from bankers about what really goes on. I mean, I'm staggered by that. I mean, what your last presentation implied was that on those loans that were bad loans, the loss of the order of 30, 40%. I mean, I don't think that's possible. But I mean, it might be wrong. Anyway, the actual, these are figures from company refs, where it's not banking numbers, but they're quite close to banking numbers, not that far away. Essentially, the total losses, recognised losses by accountants, tax authorities, and so on, in the 6 years of 2000, about £35 billion. For the whole system. It's true HBOS in 2008, 2009 was completely bust. RBS, more debatable. At any rate, that figure is a lot less than the starting capital, and to me that's in itself quite important, and quite whether all this bank recapitalisation really needed, in my view, is not terribly clear. At any rate, if we then, we do know then that there was this dramatic change in policy in late 2008, huge increases in bank capital requirements, and they did raise lots more capital. The capital shareholders' funds, figures in the accounts, I'm not, when these figures may be misleading, okay, but the figures were actually, they doubled in this 8-year period, 143 billion to 288 billion, roughly speaking. Now, obviously we started off with a period when UK banks, all claims on the state, then that kind of vanished, all claims on the private sector. And the growth rate of these claims on the private sector in the 19 years to the first quarter of 2009 was 8.4%, and the figure peaked at about 2.6 trillion. Okay. I'm afraid there was a wretched series break in Q1 2010. It's a big one, and I've got to, anyway. So, the last few decades, until 2008, UK banks' assets were basically all claims on the private sector, completely unlike the pre-71 situation. Then there was the attack. I mean, the bank recapitalisation program started, the banks had to shrink their risk assets. That would have caused a collapse in money, massive deflation and so on. It hadn't been offset by something. The banks, including of course the Bank of England, acquired large claims on the British state, with the assets offsetting on the other side bank deposits. So money growth was in fact positive from 2009-2014. There was a recession, it wasn't that bad in the end. And UK banks today hold about, including the Bank of England, and then the clearing banks and other banks having cash reserves at the Bank of England, have about £650 billion worth of claims on the state. Okay, so that's the. What about lending to the private sector? Which is really what I want to talk about, really what this is about. What has been the effect of the change in policy on lending to the UK private sector? That's really the question I'm concerned about. And it's clear that there was a change from 2009. In real terms, from this peak in 2010, there's a complication here we'll come to in a second. The loans perhaps had fallen by about a quarter in real terms, rather more relative to GDP. They're now rising roughly in line with real GDP. That's the last 2 or 3 years. This is something that, this is another way of putting it, there are these, the data is very awkward. There was a big reclassification about 200 billion to the figure in Q1 2010. And then there's also, there's a problem because of the intermediate OFC and other financial corporations, basically special purpose vehicles set up by the banks in the run-up to the crisis to avoid capital requirements. And as the securitization markets imploded, the banks had to take some of this back onto their balance sheets. There was actually a boom in this type of lending even through 2009, and of course that's not really proper lending to the private sector. So what I've done here is to take out both the serious break in Q1 2010 and the effect of the IOFCs. The bank then gives you the data, and then what you'd expect, that the peak in lending to the private sector was in Q2 2008, just before the change in the tightening of it from September, October 2008. And in nominal terms, the fall was, you can see it there, and then the fall in real terms, well, it's substantial. It's getting on for about a third. All right. The okay, getting on for a third. I've said that. I seem to have skipped some pictures. I'm sorry. One of the points I want to make here is that lending to the international lending collapsed even more dramatically than these numbers, and particularly interbank lending, which is what you'd expect. And Charles Goodhart has a chapter in the book about this collapse in the sort of balkanization of the interbank market and the collapse that followed the crisis and the capital requirements. It's pretty clear that the cause of this was, I would say, the demands for higher capital asset ratios, because the banks increased their capital. So you know. And then just talking a little bit more about this process of shedding international assets. Curiously, on the data, the UK banks didn't reduce the holdings of securities that were claimed on the foreign sector, but they did include their interbank lines very sharply, from 450 billion or so down to 200 billion. These are just the sterling, it's not foreign currency business, which also important. Now, the UK private sector by itself. Now, the UK private sector has got three bits. There's households, with charities and bits and pieces. There's mainstream corporates, not financial businesses, okay. And then there's financial institutions. And then we've got this awkward problem of the genuine financial institutions, genuine non-bank financial institutions like insurance companies, pension funds, and so on, unit trust groups, and then these special purpose vehicles set up by the banks to evade capital regulations, which effectively are quasi-banks. So that a deposit with one of these IOFCs is really kind of an interbank deposit, which is excluded from money measures. Okay, now which of these three sectors saw the largest falls in their bank borrowings during and after the crisis? This is the household sector. Obviously, predominantly it's mortgages, residential mortgages, and there is some reduction, but not much. Okay, there's a lot more to say. There must be some serious breaks in the middle there, rather awkward, but okay, not much of a fall there. So we've got it that the nation as a whole, claims on the private sector fell by about a third relative to GDP, but households fell a bit, but not that much. So where did the falls occur? They fell in lending to the corporate and financial sectors. So part of this is, of course, this household is that, as James points out, basically under the Basel capital rules, mortgages have relatively liberal treatment because they're regarded as low risk. And this then is the chart for together both the lending to all financial institutions, including the quasi-banks, the special purpose vehicles, and then the mainstream corporates. Now, the mainstream corporates is the blue line. It's much more kind of gradual and continuous than the financial institutions. The financial institutions are very much affected by this business of the surge in lending in 2009 as the securitization market collapsed and the paper came back onto the bank's own balance sheets. and then the disappearance of that stuff over the next 5 years or so. But note, you just notice the huge numbers involved. They're staggeringly large numbers, really. Then, from 2011, the Bank of England, obviously perhaps concerned about public interest in these matters, started to prepare a series on lending to large companies as opposed to SMEs. So, these numbers are all available, by the way. There hasn't been much attention paid to them, but they're all there. And this is the picture from 2011. You know, much was going on from 2009, 2010, and so on. But then you can see SME lending dropping from 177 billion Q2 2011. That had probably dropped from over 200 billion in, say, Q2 2008 to 149 billion in the first quarter of last year, which actually was the trough. So, some rather obvious points. Clearly, the fall in lending to, apparently, I mean, it seems staggering, and this is all in good faith, and I'm not making this up, and I'm very happy to be corrected on the detail of these numbers. I don't think that the guts of it will actually change very much. But lending to mainstream companies mentioned together fell by about, in real terms, about 45% from the 2008 to middle of 2015. There's now recovering a bit. I've included these IFCs, which is somewhat not right, really. There is a series, and I'm warned that this series may be a bit flaky, but okay, this is a series for really small companies, unincorporated businesses. The bank has a series of this sort, I'm not making it up. Which shows that bank lending to unincorporated small businesses in real terms, this goes over the last 2 decades, longer than, goes back further than 2011. And essentially it doubled in the decade 2008 and was subsequently halved. That's maybe because things like LLPs have come in, I don't know, but anyway, you can see there's been a very major effect from, and it can't be anything other than the bank capital rules. I'm sorry, it can't. Well, how am I going in terms of time?
You have 4 minutes, if my...
Well, I'll just very quickly, because you'll guess my views about some of these things.
4 minutes,
So
yeah.
There's a very large, there's sort of the huge changes in the composition of UK banks' assets over these decades. You know, immediate post-World War situation, then the collapse in the holdings of gilts and treasury bills. Treasury bills did vanish by the late 1990s. Then the quite long period, about 25 years really, when UK banks' assets were only claimed on the private sector. Then basically the capital rules are doing this. The capital rules come in, they cause the banks to reduce their claims to the private sector. This would have caused a thumping another Great Depression, offset by QE, so that although lending collapsed, money didn't collapse that much, and in fact carried on rising. And so now the British bank system, via the Bank of England, has about 650 billion of claims on the British state once again. The falling risk assets, mostly loans to corporates, particularly loans to financial institutions, and particularly loans to small businesses. Comes out very clearly from the data, and I would say that the problem with financial regulation is that it is always going to be biased against risk. And banks are all about risk. Involved the insurance industry. Insurance is all about risk. So you will get this aversion, essentially. What the banking system, what the financial system as a whole does, is to make it possible for society, the economy, any savers are very risk averse, but actually by pooling risks, by giving liquidity to assets, it enables society, the economy to undertake high risk, high return liquid investments, which have radical maturity transformation, maybe 15, 20, 25 years before any proper return on some of these investments. This is being impeded if you try and regulate it more tightly. So anyway, you will gather that I'm not a great fan of the bank recapitalisation programme that started really in a sense it goes back, of course, to the 1980s and the third world debt crisis and the first set of Basel rules. In some sense, some sort of financial regulation, even if self-regulation, has always been there, but I would suggest that what's happened since 2008 has had structural effects, damaging effects on the economy, as well as the extremely serious cyclical effect that I talked about in my presentations at this conference in 2013, and also in my contributions to the book on money in the Great Recession. Thank you.
Thank you.